Hello, this is Tulane University's Birkenroad Report video for Stone Energy. My name is Chris Ward, and along with my fellow analysts Erebus Dang, Molly Jubis, and Avita Zhao, we would like to thank you for watching our analyst report. Stone Energy is a publicly traded company listed on the New York Stock Exchange, traded under the symbol SGY. Stone Energy is an exploration and production company headquartered in Lafayette, Louisiana. The company operates in two main areas: onshore and offshore Gulf of Mexico, and onshore in the Appalachian Basin and the Marcellus Utica Shale. The company's stock price is $16.17 as of April 10th, 2015. Stone has a market capitalization of $954 million with approximately 56 million shares outstanding. The stock had a 52-week low of $12.07 and a 52-week high near $50. The company's stock price is $16.71 as of April 10th, 2015, which is very close to its 52-week low. Because Stone operates onshore in the Marcellus Utica Shale, as well as offshore and onshore in the Gulf of Mexico, it was really difficult to find a true peer. Stone's peer group is comprised of companies with similar market caps as Stone that have operations focused in the Marcellus Utica Shale or the Gulf of Mexico. Stone is reducing its capital expenditure budget by nearly 50% from $825 million in 2014 to $450 million in 2015. Stone is focusing 75% of its CapEx budget on deepwater Gulf of Mexico projects, while curtailing drilling in the Marcellus Utica Shale and maintaining a healthy balance sheet with no plans to use their revolver or access public or private debt markets. Based on projected company guidance, Stone is expected to produce between 39,000 and 42,000 barrels of oil equivalent per day. Stone produces oil, natural gas, and natural gas liquids. Stone has four major areas of operation: Gulf of Mexico deepwater, Gulf of Mexico conventional shelf, Appalachia region, and onshore Gulf Coast region. Deepwater Gulf of Mexico is a high-risk, high-reward operational area. Stone is allocating 75% of its 2015 capital budget to deepwater projects. Stone is focusing its deepwater program on development and exploratory drilling. As of year-end 2014, 38% of estimated proved reserves were from deepwater. In an effort to mitigate the effects from the natural decline of resources in the Gulf of Mexico conventional shelf, Stone plans to divest its non-core shelf properties to generate cash for its drilling program and exploratory projects in deepwater Gulf of Mexico. While Stone sold its interest in several non-core conventional shelf assets, it maintains its Gulf of Mexico conventional shelf core properties that continue to generate strong cash flows. At year-end 2014, Gulf of Mexico conventional shelf properties contributed for about 2% of its estimated proved reserves on a barrel of oil equivalent basis. Stone owns about 90,000 net acres of Marcellus Shale leasehold rights in the Appalachia region. The company plans to curtail drilling in Appalachia this year. Stone's Appalachian properties supply 58% of its proved reserves as of year-end 2014. Next, Stone plans to evaluate and expand into the Utica Formation. Our investment thesis consists of 5 main points. Stone is well positioned to operate in an environment of lower oil and natural gas prices. The company maintains a strong financial profile. Their shift to oil brings both risk and rewards. Stone's 2015 CapEx budget proves that it's all in on deep water. We believe that the stock price tumble provides an attractive entry point. We give Stone a market outperform rating, and our 12-month target price is $21. Saudi Arabia is no longer acting as the swing producer. As a result, production is not slowing down at a fast enough rate. Stimulus programs have been enacted globally, but demand is still weak. Prices continue to fall, and as a result, the lowest cost producer will win. We think that Stone is well positioned because it operates in two of the lowest cost basins in the non-OPEC world. Management's goal has been to maintain a strong financial profile to help the company better withstand the downturn in prices. Currently, Stone has $225 million of cash on hand, $500 million under its undrawn revolver, nearly $456 million worth of hedges, and it has debt maturities of $300 million due in 2017 and $775 million due in 2022. We want to point out that Stone has no significant debt maturities coming due within the next 12 months. Stone's shift to oil brings both risk and rewards. The Gulf of Mexico and Appalachia are both low-cost basins. However, in the Gulf of Mexico, Stone already has significant infrastructure in place, which significantly lowers its operating costs. In addition, it receives premium pricing as Louisiana Light Sweet trades at a premium to West Texas Intermediate. However, operating the Gulf of Mexico ultimately exposes Stone's investors to more geological and operational risk, and their revenues are more heavily exposed to the price of oil. As previously mentioned, Stone's 2015 CapEx budget is heavily weighted towards deep water. 75% of the 2015 CapEx budget of $450 million is weighted towards deep water operations. Stone is all in on deep water. Just let me know when I go. Stone's current stock price of $16.71 is very close to its 52-week low of $12.07 and offers investors an attractive entry point. Our valuation for Stone is based on our PV10 analysis and our enterprise value to production multiple. We took an average of the two and came up with a 12-month target price of $21. This chart shows a valuation of Stone Energy compared to its peer group. In summary, in the current declining price environment, there will be winners and losers. The environment favors companies with strong liquidity positions as well as healthy credit metrics, but more importantly, those that have a low cost structure with the ability to shift production to oil will be best positioned to thrive in the downturn. Stone has curtailed drilling in the Marcellus Utica shale and will focus the majority of its capital budget towards more valuable oil operations in the Gulf of Mexico. Stone has hedged 50% of its production at an average price of $91 a barrel and $4.15 per MMBTU. It has $252 million of cash on hand and $500 million available under its credit facility, further supporting a strong liquidity position. In addition, the company has healthy credit metrics with a low debt-to-asset ratio of 38% as well as a low debt-to-equity ratio of 95%. Most importantly, Stone operates in the Gulf of Mexico and Appalachia, which have the lowest average break-even cost in the non-OPEC world. The company owns two production platforms in the Gulf of Mexico, which significantly reduce its operating costs, creating an even lower cost structure. Together, these advantages should allow the company to better withstand this challenging environment than its peers.